Hi everyone. So today we will try to understand activity or turnover ratios. So first we'll understand what is the activity ratios. So activity oblique you can say turnover ratios. So in accounting you will see six ratio under this major head or major category. For example, inventory turnover ratio, trade receivable turnover ratios, trade payable turnover ratios, fixed asset turnover ratios, working capital turnover ratios. So all those ratios will cover under this major heading. So first, let's understand what is the meaning of activity ratio. So basically, activity ratio indicate the speed at which activity of the business are being performed. From starting to end, how frequently all these activity turn into sales or revenue. So the activity ratio express number of time asset employed for that matter, and any constituent of asset is turned into sales and accounting period. So basically here purpose is to identify that okay, in how many times a particular asset okay deployed first into the business, and that turn into sales. So in a accounting period, so we are talking about for a accounting period, okay, that is the activity ratio accounting period. In a accounting period, how many time this particular process completed, so that is the activity ratio. So activity ratio basically first let's understand inventory turnover ratio. Suppose first ratio is inventory turnover ratio. So inventory turnover ratio means inventory turnover ratio. So it means how many time in a accounting period inventory infuse into the business, and that inventory result as a sales or revenue for the businesses. That is called inventory turnover ratio. For example, if inventory turnover ratio comes to, it means during a year two times inventory, if you enter the inventory into the businesses, it will convert that inventory from businesses all process, buying the inventory, putting into the warehouses. From warehouses it will go into the production activity, then from production activity it will go into the sales, and then it is revenue. So two times inventory can be converted into the sales. So two means here two. If it is three, then means three time inventory can be converted into the revenue. Okay, so the formula to calculate this inventory turnover ratio is basically cost of revenue from operation. Cost of revenue from operation divided by average inventory. Average inventory. Okay, so this is the formula to calculate the inventory turnover ratio. Now, first we'll understand that okay, what is the cost of revenue from operation. So first point is cost of revenue. How you will calculate cost of revenue? So cost of revenue, basically you can calculate sales minus gross profit. So that will be your cost of revenue. That is the one way. Other way, if you are getting all the details, then suppose you do not have sales, do not have GP, and you have some other details. For example, opening stock you are having, closing stock you are having, purchases during the year you are having, some freight, direct freight also available. So from this detail you can also calculate. Here basically purpose is to calculate cost of revenue or cost of goods sold. Okay, so number one thing, you calculate like this average inventory. How you will calculate average inventory? So average inventory basically opening inventory plus closing inventory divided by 2 will be your average inventory. And that is how once you calculate these two figure, you can easily calculate inventory turnover ratio. So this is very simple. Now let's understand what is the meaning of inventory turnover ratio. If it is low, then what is the consequences? If it is the high, then what is the benefited? So please, one thing keep in your mind, that all the activity or turnover ratio is good in the higher side. If your activity ratio is higher, okay, so that is the good situation for any of the businesses, because activity converted from starting to ending point at very early point of time or many time in a accounting period, it will be good for the businesses. So this thumb point you can keep in your mind and remember that all the activity or turnover ratio will be in the higher side, good for the businesses. So now discuss specifically for inventory turnover ratio, that okay, if it is low, then low turnover of inventory may be due to bad buying, obsolete inventory, etc., and danger signal. Okay, if in any businesses low inventory ratio is there, suppose 1, less than 1, okay, so if it is 1 or less than 1, it means either their buying strategy is not good, or they are obsolete inventory. They might be having some obsolete inventory. All the old inventory may be laying in the go down, and that is why this ratio is never getting increase from there. So that could be the two positions. So if the ratio is lower, then management has to find out the reason why this inventory turnover ratio is at lower side. Similarly, higher turnover always considered as good, but if it is more on the higher side, then again if management thinks some kind of the doubtful situation, you can say, then they have to see what is the reason. Because many time what happen, if you buy in small lot, okay, and selling things quickly at a low margin to realize the cash, that could also lead you as a higher this inventory turnover ratio. So if suppose your lot very small lot, if you are buying in small lot and selling at a very lower margin, in that case your this inventory turnover ratio will be at a higher side, 5, 10, 6, whatever could be, any number it could be. So in that situation you have to identify that okay, this ratio at a higher side and it is good, but we have to came to below at a, at normal level. We have to keep this, because if you are buying things in a small lot, it will cost to your company. So again, if you are selling at a lower margin, again it will cost to the company, so that ultimately your net profit is not increasing, but your inventory turnover ratio is get increasing every year. So these both situation, you understood that okay, when it is at lower side, you have to find out the reason. Okay, if the inventory ratio is at lower side, you have to find out reason why it is lower side. One reason could be bad buying strategy is not proper. Second is lot of material staying in the obsolete conditions in the go down, and that is why your below, whenever you calculate this average inventory, it is more, and that is why this ratio will not increase. So that is the one condition. If it is higher side, then higher side is good prima facie, you do not have to do any kind of doubt on your ratios. But if you see consistently it is increasing, then the reason could be that your company is buying in a small lot. That is the number one reason. Second reason could be they are selling at a very low margin. Okay, so that situation you have to see from profit perspective. If your profit is increasing, then it's fine. But if your profit is not increasing, but your inventory turnover ratio is increasing every time, then you have to do more analysis. Okay, that's all. So that's all from my side.